Good afternoon, everyone. Thank you so much for joining us today for the second series in our webinar series, the Savvy Women Investor Series. And today is all about defining your financial goals. So today we are going to be focusing on that retirement planning piece. And before we begin, I'd like to start off by thanking the McGill Women's Alumni Association for inviting me to speak today. I'm honored to partner with them, and I'm really excited to be here with you today to share this information with you all. I encourage you to ask some questions if you have any questions that come up, and we can address those as the session goes on. Just a little bit of background about myself. My name is Keeley Simpson. I am based in Toronto, Ontario. I have been with BMO Nesbitt Burns for 14 years now, so time flies. I graduated from McGill University. I have my Bachelor's of Commerce in Finance and Accounting. And I am a mom of 3 little ones, 3 kids, 3 and under, so things are busy over here. I also have 2 dogs as well, so things are busy, and hopefully, since we're all working from home here in Toronto with the stay-at-home order, everybody stays quiet for this session today. So anyway, so again, I'd like to thank everyone for joining, and without further ado, we'll get this show on the road. So today, money is genderless, but investing for women is different. And what I mean by that is that generally women tend to be a little bit less confident in their knowledge about finances than men. And this uncertainty extends to retirement planning, financial products, and services. So the goal for today really is to empower you to take control of your financial goals, whatever those goals might be, and to provide you with knowledge in order to guide you to get you closer to that point. Also, in terms of risk, it comes as no surprise, obviously, that some studies indicate that men are more likely than women to take risk. That's just when it comes to personalities. They are twice as likely as women to describe their RSP investment style as aggressive, whereas women tend to be more on the conservative side. So these are just a couple of the differences that we're going to touch upon today. I'd also like to start with a quote that I think will just sort of set us in our broadcast today. So planning is bringing the future into the present so that you can do something about it now. And this is by Alan, personal time management author. I'd like to start with this quote just because, you know, you're here for a reason today. You're here because you have some goals that you want to listen to us about how to achieve those goals. So that's really the primary focus today, is the planning piece. So our agenda today, I am going to start off with a quiz. So if you have a pen and paper handy, I'll go through that with you in a few moments. Then we're going to talk about why investing for women is different, the unique challenges that women face when it comes to planning for retirement. We're going to talk about the 9 biggest retirement mistakes and how to avoid them. We're also going to be building a plan today, so the basic steps to building your net worth so that you can have that to take away with you today. So I would definitely get a pen and paper handy for that. We're going to also touch upon what responsible investing is exactly, because we've received a lot of questions about responsible investing. And we're also going to talk about the selecting an advisor piece so that we can provide you with some information about the different advisors that are out there and what to be looking for. So for our quiz, to maintain your current lifestyle after retirement, how much capital will you need to have saved? So just think about that for a minute. What are all of your sources of retirement income? Do you know all of them? How much income is each one going to provide you with? And what percentage of your gross income do you currently save on a monthly basis? And what is that of your net income? And finally, what was the return on your investments or savings last year? I mean, obviously last year was a bit of an anomaly with everything that happened in the markets, but just over the past couple of years, are you able to to think about what your rate of return was. Do you know what your rate of return was? So based on the many studies that have been done over the past few years, women tend to learn before they invest. So women like to be very informed and knowledgeable before they invest, and they also communicate differently. Obviously, women have different life experiences than men, and statistics show that women on average invest in more conservative investments. So that's one of the primary differences. And then, you know, today what we're really going to be doing is you're basically taking this really important step and becoming more informed about managing your own investments. And that's really what I want you to take away today. I have lots of different resources that we're going to talk about. So if there's any information that you'd like more details on, just let McGill know, and we can send that out to you. Because we want to make sure that you have all the resources available to you if you want more information on anything. So some of the unique challenges that women also face when it comes to actually planning for retirement are, you know, it is typically presented as a couple's experience, which generally may not be the case. So sometimes, you know, there's divorce, there's some women become widowed, and some women don't marry at all. So it's not fair that it's always presented as a couple experience, because it may not always be the case. Women tend to have accumulated a smaller nest egg, and that's only because women, if women need to leave the workforce for a few years to take care of children, or women generally tend to be the ones who will help take care of their parents when they're older. So if you need to leave the workforce for that as well, then you know you're taking time away from being able to earn that income and build up that nest egg. Women are also living longer today, which means that whatever amount that you've saved over the years will have to last you longer. There is that confidence when it comes to investing piece, which is what we're here to focus on a little bit more today. So giving you those tools in our toolbox so that you can feel more confident in your ability to understand what the different realms of investment looks like, right? The non-financial aspects of retirement as well, that women do come out ahead. So what I mean by that is that men typically tie their identity to their careers, and women, we tend to build relationships outside of work, and we are also the ones who are the caretakers and caregivers for our family members. So we tend to come out ahead when it comes when retirement comes our way. So really what I'm wanting to say by that is that, you know, men and women are complementing each other when it does come to that retirement experience, which is always somehow typically, you know, presented as a couple experience, which is not always the case. So this is a retirement expense worksheet that I have available in Excel format, where you can put in your mortgage or your rent, your condo fees. So you can basically input into this spreadsheet whatever your monthly costs are. And then you can put in that it's fixed or discretionary. And then we can also transition that to what that would look for in a future expense amount. So when we account for inflation, how much is that going to be in 10 years from now when I retire, or in 20 years from now when I retire? So if you would like this retirement expense worksheet, just let us know and we can email that out. So what does retirement look like to you? So these are some of the things that I wanted us to focus a little bit on, which I just mentioned. So we are living longer. It's no longer a set point in time. It used to be that, you know, in 60, even Freedom 55, right? It's no longer you're turning 65 and therefore you're going to retire. So, you know, this is one of the key differences from planning today versus, you know, 10, 20 years ago. That sandwich generation where we are also taking care of our adult parents at the same time as our children. We have this declining pension piece, which means that companies today are not, they're not putting into a company pension plan for employees the way that they used to in a defined benefit plan. It means that the responsibility is on you as the employee to save for your retirement. There is a lot of companies out there that do a matching, like a matching RSP contribution or group RSP, but it used to be that there would be a pension plan that companies would provide you with and that you could just, retire on. And then retiring with debt. So a lot of people now are retiring with, some mortgage debt and even some other kinds of debt as well. So those are some of the key differences today. So these are some of the rules of thumb or retirement myths that you may hear a lot about. So I'm fine to have a company pension plan. So again, that's not really applicable today, just because most companies don't have a defined benefit plan that they offer employees anymore. I need 70 to 80% of my pre-retirement income. So this is another rule of thumb that you could use if you wanted to try and calculate something just roughly. I've heard that I needed to save $1 million. That was probably true many years ago. Now it's probably more just because of inflation. And I will be fine if I only withdraw 4 or 5% a year from my savings. This is also true as long as your rate of return on your portfolio is higher than the current rate of inflation, net of your fees. So really, there's no one size fits all solution, is basically what I'm trying to say here. So these are the 9 biggest retirement planning mistakes that we see. So in my role at BMO Nesbitt Burns, I'm an associate portfolio manager and I'm also a wealth advisor. And I work on a team, there's 4 of us on the team, and we manage 215 households. And what we see most often when it comes to retirement planning with our clients is we want to make sure that we build out a worst case scenario, a financial and retirement plan. So what happens if you suddenly can't work anymore because of a disability and you didn't have disability insurance? What happens if your spouse or partner who may or may not earn more income than you can't work anymore and something's happened? So what happens in these what if scenarios? So it's really important to build a worst case scenario for your planning so that you're not caught off guard. Another thing is outliving your wealth, right? So ensuring that your nest egg is going to last you 30 plus years because we are living longer today. Failing to account for inflation, especially today with everything that's happened with this pandemic. What we're seeing now is that the costs are rising, and obviously the Fed in the United States, they're trying to say that inflation is not a concern right now, but what we're seeing is that even just food is more expensive right now, gas, everything. So grains are more expensive, lumber. So if you were building a house in the middle of this pandemic, or you were about to build a house or do a renovation, your costs would have gone up by 30 or 40% just for lumber, right? That's crazy. So accounting for inflation is really important. How and when to maximize the Government of Canada, the CPP benefits, and if you're in Quebec, of course, the Quebec pension plan benefits. Creating a consistent, a stable and reliable retirement income stream. So at the beginning of the presentation, I asked you during our quiz session, I said, do you know the 3 sources of your retirement income? Do you know how much each of these are going to pay you? When women leave the workforce, not only are we leaving the workforce for a year or 2, however long you need, if you leave the workforce, of course, that means you're also not contributing to the Canada Pension Plan, to the EI plan, right? So these are some factors to consider when you are planning for retirement. Minimizing and reducing your taxes, both leading up to and during retirement. We don't talk enough about this, where when you are retired and you start drawing on your portfolio, what does that drawdown look like for you? Does that mean that you're going to be paying higher taxes when you are retired? Reducing your fees and minimizing costs so that you can keep more of your savings, of course. So looking at however you're managing your investment portfolio, reviewing your investment management fees. How much is this costing you to invest, right? So you want to try and minimize those costs so that you can keep more in your pocket. You want to work with an advisor who is a fiduciary. And what I mean by that is a fiduciary is someone who has a portfolio manager license. This is someone who will always have your best interests in mind when they are managing the portfolio on your behalf. So this is something that you want to look for. Missing out on the growth and upside in equity, sometimes fixed income markets, not lately, obviously. So you want to try and focus on improving your returns and your bottom line results. And we're going to focus a little bit more on that later on in this presentation today. And you want to focus also on protecting and preserving your portfolio, especially if we enter into another 2008 market environment. So last year, the market went down 35% last March, and it somehow recovered much faster than a lot of us thought it would. So if you were about to retire and your portfolio went down by 30%, that can be a big hit. So these are the things that you want to think about. And I'm not trying to paint a negative picture here. I'm just trying to make you think about what is my worst case scenario and how do I plan for that. So just to reiterate, when it comes to women, we're also taking care of our parents. We may also be taking care of our parents. We may leave the workforce for a longer period of time to take care of children. We may even have adult children returning home when we're actually thinking about retiring. We may be caring for grandchildren so that the parents can work, right? Outliving your spouse. There's also divorce. So working longer, how much and in what capacity. There are a couple of checklists I do have available. There's a checklist if you are 10 years to retirement or if you're 2 to 10 to retirement. So some of the things that you want to consider if you're 10 years from retirement, and I can send this out. I won't spend a lot of time on this just because you can have the PDF and read it if you're interested, but you want to set up a continuous savings plan. You want to consider, well, actually we're going to be covering this, the investing early to generate and take advantage of compounded growth. So we are going to be covering some of this later on in the presentation, but if you want this checklist, just let us know and we can send that out. And the 2 to 10 years to retirement as well. You want to make saving a priority. You definitely want to create your retirement picture. If you're thinking about retiring in the next 10 years, you want to know what that's going to look like. And you want to look at what your current and future expenses are, because this is what's going to determine how much you need to have saved. So I'm going to pause now for some questions that came in, and then we're going to continue with the presentation. So some of the questions that came in were, when and how should we invest for our kids? So we're going to be talking about that in a few minutes. You can invest in what's called an education savings plan for your kids. And if you're in Quebec, there's also an education savings company or firm, agency is what it's called. And they have some really great options available in Quebec specifically, which you may want to look at. And you want to invest early. Basically, you want to invest early for your kids because it will maximize the amount of compounded growth that you can gain in that account. And you want to invest early in the year. And there's also, an amount that is sort of an optimal amount to contribute to get those Canada Education Savings Grants that the government puts into the account for you. So we can send out more information on that if you'd like. But basically, if you were to contribute $2,500 a year for each child, if you can contribute $2,500 a year on top of retirement savings and everything else that we have to focus on, then you would get that $500 education savings grant from the government, which would also help build up the plan as well. Another question was, can you speak to investing for profit and for planet, how to make good decisions with ESG in mind? Thanks so much. So we actually have a whole section on this today because we've received so many questions on it. The last presentation, I actually have a whole section dedicated to this, so stay tuned on that one. How to further grow the wealth after reaching assets of 1 million and over. I would assume that the methods could be different from a certain threshold. So yes, well, you want to make sure that your dividends, if you have investment accounts, you want to make sure that your dividends, if you don't need access to those dividends from a cash flow perspective, are being reinvested in your plan. So that will help accumulate the net worth and help grow the plan even more. You want to make sure that you have a tax strategy for your investments. You want to make sure that you are taking into consideration maximizing your tax-free savings account, a tax-free savings account for partner or spouse, for adult children. These are the areas that you want to focus on. You want to make sure that you have that tax hat in the back of your mind at all times to make sure that you're not, giving it away, quote unquote, to the CRA. And how do you know when to invest in RSPs or TFSA and when to let it go for a year? So this is a great question. I get this a lot. So I have a whole slide on RSPs versus TFSAs. So we can touch upon that as well. It's a great question. And I think that those were the only ones that came in early. So if you would like to ask some questions, please feel free, and I will keep going in our presentation, and you can ask some questions and I will answer those at the end. So now we're going to talk about the basic steps to building your net worth. So the first thing is that you want to have a plan. So you want to create a balance sheet for yourself. How much do you spend and how much is left over? You want to create a statement of net worth for yourself. So what is in that? How much do I have in terms of my assets? So what do you own? So that would be your house if you own your house. That would be however much you've saved in your savings accounts or your RSPs or your tax-free savings account. You want to add all of those numbers in, and then you want to deduct whatever you owe, right? Your liabilities. So if you own a house and you have an outstanding mortgage, one minus the other would give you your net amount, which contributes to your net worth. So your net is your net worth, and then you determine what your net number is. The next thing is that you want to pay yourself first, right? So if you are, if you're working right now and you're working obviously really hard, you're working in the middle of this pandemic that's been going on for so long now. So you want to think about how much can you save and how much should you save every month to reach your goal, so that you know exactly how much you can afford in that savings plan, that continuous savings plan that we're going to talk about. So you want to have a budget, which goes back to my expense worksheet that I'm happy to send out if you are interested in it. You want to have an emergency fund. I know it's very hard to build up an emergency fund as well as save in all of these other buckets, but it is important to make sure that you are covered if something were to happen to your employment status and you needed access to funds, or your partner ends up losing a job and can't work for a while. You want to make sure that you've built up enough in that emergency fund. I try to tell most of my clients that you want to have at least 4 months of net income saved in your emergency fund. And sometimes this takes years to build up on top of your RSP contributions, your tax-free savings account contributions, your education savings plan contributions, the cost for daycare or school or mortgage. Like, I know it takes a long time, but that's why you want to have a budget, because you want to make sure that you're referencing that budget all the time to see, where can I save $25 for my emergency fund this month? Where can I do it? And just focus and get yourself that emergency fund built up so that if something did happen, you could rely on that for a few months. You want to have an RSP, which is a retirement savings plan. This will allow you to get a credit from the CRA when you're doing your taxes, and then you can use that to contribute to your tax-free savings account, or put it into your emergency fund, or put it into your education savings plan. You want to have a tax-free savings account, and you want to also have a reinvestment program within any of these accounts. What I mean by that is you don't want to have these accounts sitting in cash. You want to have a savings program or an investment program that you can rely on to keep helping you build up your net worth over time. So we're going to talk about that. We're going to talk about the 2% difference, which I think will be very interesting to you. And it will just show you what that 2% return difference, what that can actually mean for your investments over time. So in terms of setting our objectives, we want to set what our goals are, right? So if your goal is to buy a house or buy a second property or an investment property, what does that look like for you? If your goal is to beef up your retirement savings and make sure that you would be okay to retire in 10 years from now, then that's what you need to focus on. If you want to make sure that your children's education is fully covered, then that's something that that you want to plan for. If you're in an estate planning phase, then you want to look at how to minimize taxes when it comes to estate planning. If you have proceeds of insurance that you can invest in, or even gift planning. Gift planning has become very popular as of late with many of our clients. And if you want any information on that, we'd be happy to send it. But it's become very, very popular as of late with clients that want to make sure that they have a legacy going forward after they're gone. So you want to develop a retirement plan. So these are the 3 sources of retirement income. So we talked a little bit about this in the 9 biggest mistakes that can be made and how to avoid them, right? So you have your government plans, and that's your CPP, your Canada Pension Plan. If you're in other provinces aside from Quebec, if you're in Quebec, it's your Quebec Pension Plan. You have your old age security, which can be clawed back during retirement if your income is too high. And you want to make sure that you're looking at what your tax situation is to maximize all of these sources of retirement income, right? You have your company pension plans if you have a company that is matching with you or is providing you that defined benefit plan. And then you have your personal savings, which is your RSP, so your retirement savings plan, and your tax-free savings plan. So replacing today's income, I had used a 5% inflation rate here just because the CPI. And so if your income today was 60,000, 10 years from now, that would mean that you would need to have 98,000. 20 years later, it would be 159, and then 30 would be 259. So all I am trying to show with this is that an apple today is not an apple tomorrow, and that your investments need to be growing in order for you to keep up with the pace of inflation, especially if we enter into a time where inflation is going to be a very big concern, which we could actually be heading into in the next couple of years with how low rates have been with the pandemic. And also with the cost of goods going up, supply and demand, the supply chain has broken down. I mean, there's a variety of reasons as to why inflation is a concern right now, and that's something that you want to think about. So the advantages of a retirement savings plan is that you get tax deductible contributions. So if you put in $5,000 to your plan, you should be getting money back from the CRA when you do your taxes. And you also benefit from what's called tax deferred compounding. What that means is that you do not pay taxes from the income earned in that plan, and you don't pay capital gains taxes on any gains that you take in that plan. So these are just some of my rules to live by. So you want to open a retirement savings plan account if you are earning T4 income. You want to contribute your maximum if it makes sense. And what I mean by that is if you have higher income earning years ahead of you, you may want to try and keep some of that room for when you can put more into your plan and get more back from CRA. You want to contribute early each year. So earlier in the year means that the tax deferred compounding is going to basically build up that plan to a higher account balance because you've had more time in the year for that to grow. And then I think it also makes a lot of sense for you to consider contributing something monthly. So when you're putting together your budget and you're looking at how much can I afford to save, I think if it just comes right out from your account and right into a continuous savings plan for you, and you know that every single month that, you know, if it's $50 or $100 or $500 is coming out, then you know that that's where it's going, so that you can't be at the end of the year and say, oh, I forgot to save, or I wasn't able to save. If you carve out a small amount monthly that you're directly putting into your plan each month, that will help you in a big way. And then you obviously want to invest wisely. And what I mean by that is the 2% difference, which I'll leave on the screen here. So if you put in $5,000 every year to an RSP, where you get that tax deferred compounding, and you had a 6% rate of return, year 5, your account balance would be $29,877. But if you had a 10% rate of return, it would be $33,000. But if you just look at how this makes a big difference over, let's say, 20 years, if you had a 6% rate of return, your account balance would be $194,964. But if you had a 10% rate of return, you would have $315,010. So you can see how this 2% difference can really make a big difference on your account balances and help you reach your retirement goals a little faster if you invest wisely. So the tax-free savings account was introduced back in 2008. And right now you can contribute $6,000 per year. So back in 2020, they kept the same limit, $6,000 a year. And if you've never opened a tax-free savings account before and you had turned 18 before 2009, you could contribute $75,500 today. The reason that this is so powerful is that the investments grow inside of the account tax-free. So the interest and the dividends, the gains, they all grow tax-free. The thing is, though, is that when you contribute to this account, you're not getting money back from the CRA for making a contribution like you would with the RRSP. But if you needed access to this money in this account, you're also not going to be dinged with a tax bill by accessing it. So some of the rules is that you don't want to over contribute, because you can be charged a penalty if you have. And you don't want to contribute, withdraw, and contribute again in the same year. Now, if you did have if you hadn't maxed out your limit, then you could do that in the same year. But you want to be very careful because of the accounting behind the scenes with the banks. Sometimes CRA doesn't get all of the information, and you don't have all of it available to you on your assessment right away. So you just want to be careful about that, and you want to make sure that you're not going to be in a situation where you're going to get a penalty. So the RSP versus the TFSA comparison. So if you were in a marginal tax rate of 40% when you contributed to either the RSP or the tax-free savings account, you use that pre-tax income amount, so it'd be $5,500, right? Income tax payable would be $2,200, but anyway, so that net contribution to your TFSA would be $3,300. But if you contributed it to your RSP, you wouldn't have any income tax payable on that because you would be getting money back from the government. So let's say you have a 5% growth on both accounts. The value 20 years later would be $8,756 for your tax-free savings account. And your RSP would be a lot higher, obviously, it'd be $14,593. But when you withdraw the money, because you would have to pay taxes on that withdrawal, of course, is you would have the net, it would be the net the same, it'd be $8,756 in both cases, right? So I think this RSP versus tax-free savings account question really comes back to, what is your marginal tax rate right now? Where does it make most sense for you to be saving your money so that you can get the most amount of money back from the government? Because otherwise that's kind of wasted. And then you want to look at, where do I have extra funds that I can then contribute to my tax-free savings account, or use that return that you get from CRA to contribute to the tax-free savings account and to the retirement education savings plan, so that you can maximize all of your buckets. I think really what this comes down to is that you want to have a balance. You want to have a balance between your plans, and you want to have a balanced strategy when it comes to saving. And I don't think it makes a lot of sense to say you should always focus on maximizing your RSP, because that's not always the case depending on what your marginal tax rate is. So I think that this is important to note. We also have this available if you want this to look at in a PDF format. We can send that out as well. So your investments, how long will $250,000 last? So if you were to retire today or 2 years from now, how long is that money going to last you, right? These are some of the questions I get a lot. And if you were to take out $18,000 a year beginning today, if you were to retire now, then that portfolio is going to last you 18 years. But if you were to retire 2 years later, then that portfolio will last you 23 years. That amount of money will last you 23 years, assuming it's 6% a year and nothing happens, which is unrealistic, obviously. But it just goes to show you that there are some legacy decisions when it comes to working longer. But working longer, you know, how much and in what capacity is what I hear a lot from my clients. So I just thought I would show this so that it can show you that your portfolio will last an extra 5 years if you were to wait to retire, you know, 2 years. So the next part of our presentation is creating and managing your investment program. So this is the part of the presentation that I'm going to show you what different investments are and what different investments, what you can expect from different investments. And I don't mean to rush through them. I just want to make sure that I have enough time at the end to answer these questions that you have. So I'm going to go through them in a way that I think will provide you with the most benefit. But if you have any questions on this at the end, or want more information on it, just let us know. So the first thing when we talk about managing your investment program is you want to look at what your needs and your objectives are, right? You want to look at what your current financial picture is and how much risk can you tolerate. So if your portfolio were to go down 10%, would that keep you up at night? Or would you be calling your advisor and saying, here's an extra $5,000 that I had in my emergency fund, please put it to work because I want to take advantage when things are cheaper. What is your time horizon? Do you have 5 years to retirement, 10, 20? Are your kids going to be going to school in 5 years, 10 years? How much time do you have to grow your portfolio to make sure that you have the right asset mix? And I'm going to come to that in a few minutes. What is your knowledge when it comes to investing? And what is your time commitment? And what are your goals? So the investment menu is like this. So you have short-term, fixed income, and common equity. So short-term is something that's invested for less than a year. You have fixed income, which is bonds and preferred shares. Bonds right now are basically offering a very low rate of return and actually a higher risk because interest rates are so low, and we know that interest rates are going to go up eventually. So that means that bond prices are going to go down. So there is some risk when it comes to investing in bonds right now. So I don't want you to think that that means it's, you know, risk-free, because it's not. Preferred shares is another area that you can invest in when it comes to fixed income, and then stocks. So in terms of short term, there are treasury bills, which most people don't buy today, and GICs, which is a guaranteed investment certificate. Your real rate of return is calculated in a way that you take your rate of return, let's say it's 6%, and then let's say inflation was 2, so that makes it 4 minus whatever taxes you've had to pay on your investments. But most of the time, people can get away with a tax-free, a tax-free return because of your RSP and your tax-free savings. So that gives you what your after-tax rate of return would be. Government bonds and corporate bonds these are two ways to buy bonds. There are government ones, so Government of Canada, the Province of Ontario, the Province of Quebec, and corporate bonds. So TD, ARC Resources, but not a great example because they don't have very good quality debt right now. But that's the thing, is that you want to look at what the credit rating is when you're buying corporate bonds. You want to make sure that it's a safe investment. Preferred shares, you have regular dividends that come in for the most part. They all come with what's called a credit rating. So it should give you an idea of, can they pay those dividends on a regular basis? And historically, prices tended to be less volatile. That hasn't really been the case for the past few years because we've seen such a spread when it comes to interest rates, and they are very interest rate sensitive. So this is something that you want to consider. With stocks, you have ownership in that corporate stock. You have dividends, and you can get a dividend tax credit if you're investing in a non-registered account, and you have that capital appreciation potential. With dividends also, you have that option to do what's called a dividend reinvestment plan in your accounts, which will help you build up that net worth so much faster because the dividends are constantly buying more shares of that company. So if it's BCE, for example, BCE has a 6% dividend yield. Every single time that they pay a dividend, you could be buying more shares of BCE, and you'll just keep accumulating over time. You have this asset mix factor, which is a key factor. And what does that mean? It means that you need to decide what your strategic mix between stocks, bonds, and cash is going to be. And this goes back to your risk tolerance, right? Why this is important is because it does have a strong influence on that risk and reward trade-off, which means that the more you have invested in common stocks, the more your portfolio will go up and down, can swing up and swing down. And really, it comes back to that time horizon. So how long do you have to invest? And what is your risk tolerance? So can you handle these market swings? This volatility that we are seeing in the markets right now is, I don't want to say unprecedented, because we've seen this for many years now. In the past 5 or 6 years, we've seen a lot of fluctuation in the markets. But especially with the pandemic, and there's still a lot of uncertainty with that, you're going to see more volatility now than you would in the past. So last year we saw the markets go down by 35%, and this is just to show you that in a 5-year time frame, the markets have gone from A to Z, and these are all of the upswings, downturns that you can see, and you can see that last year it eventually did recover, and it did recover quite nicely. And just last week we hit all-time highs again. So I think the important piece here is to know that if you are going to invest in stocks, you need to be aware that it can go up and down, and that those swings generally, if you hold on, if you have a longer time horizon, that should benefit you in the sense that you don't want to sell when things are down. You want to hold on, and you want to get paid while you wait. So you want to have a focus on companies that are paying dividends, that will keep paying their dividends when we have a market downturn, where you can get paid while you wait and build up units of those stocks at a cheaper price, right? So diversification produces risk. So there's, a lot of people say that the more companies you have, the better in your portfolio because it's diversified. But there comes a point where around the 30 company mark, diversification, it's not optimal at that point to have 40 or 50 because then your return will not be as high. So I think you want to focus on some of the areas in the market right now that we're seeing a big uptrend in are cyclicals. So US financials, Canadian financials, technology last year worked really well. It's not working as well this year. Healthcare last year worked really well. It's not working as well this year. So when we talk about diversification, There's diversification by asset type, so bonds, so fixed income or stocks, and then there's by industry. So technology, healthcare, consumer staples, consumer discretionary, financials. What's working this year, because things are actually opening up down in the States, unlike here in Canada and especially in Ontario, we're not feeling that right now, obviously, but eventually we'll get there. They are reopening down in the States right now, and so we have this what's called a reopening trade. And so cyclicals have been performing better this year than what worked last year, which was more of the stay-at-home stocks, or the stay-at-home stocks, like the Amazon, Microsoft, all of the things that basically worked last year aren't working this year. So it's important to make sure that when you are looking at how diversified you are in your portfolio, you also want to make sure that your industry selection is matching what's going on macroeconomically in the world today. Where is the best place to have your funds invested? And by country, of course, so Canada, US, international, emerging markets, right? So some of the current market conditions I've already covered, but basically some of the concerns are that the yield curve, which is the difference between the long-term rates and the short-term rates, is basically pointing to this area where we're going to see some inflation concerns. So these are some of the things that we're seeing in the markets right now. But again, we have this reopening trade. So we want to make sure that we have cyclicals in our portfolio to take advantage of that reopening trade. What is responsible investing? Because I get this a lot. So an ethical investment, so SRI stands for, so it's ethical investment negative screening, SRI. So it's screening for potential investments against a range of defined criteria. So that means that you're aligning with values. You want to look at what the risk management is. So what kind of materials, you want to provide an analysis like this. You don't actually have to do this yourself, by the way. They have a lot of different programs out there that will tell you how a company is rated on an ESG score. And there's actually an index out there called the MSCI ESG Index, which will give you how a company ranks from a sustainable investment perspective, right? So really it's aligned with values, risk management in the corporation. They have sustainable opportunities and they have active ownership. These are the sort of the things that we look at when it comes to responsible investing. We also have a global sustainable investing guided portfolio that we manage. It's managed by the Portfolio Advisory Team, Action Team. And really what this is, it's an equal-weighted portfolio for the 20 large cap stocks that are on a global basis. They are members that are selected by the PAT team, which is what I just mentioned. I just thought I'd give this as an example. And I know that the stock names are really small, but if you want more information on this, I'd be happy to send it out as well. But the portfolio really takes advantage of the strengths in each of the markets, right? So Canada, US, international, but has that global sustainable investment portfolio lens on. So some of the companies that they invest in are Lind PLC, which you may or may not know of. I'm trying to see some of the names that you would recognize. So Walt Disney is one of them. Coca-Cola is another. Accenture, which is the consulting company. Microsoft, which I just mentioned. PayPal is another. Boralex, NextEra Energy. So these are just some of the companies that have been vetted from that sustainable investment lens piece. And all of these companies would have a high ranking when it comes to the MSCI, that ESG score. So when is the right time to invest? So we always enter into these risks of market timing, which I just showed you on that graph, right? If you were to sell when things went down by 35%, you would have lost 35% of your capital. So you want to make sure that you stay invested when things, especially when things are volatile, and you want to make sure that you have the right asset mix for your portfolio to make sure that you are comfortable taking on those risks. You always want to take a long-term perspective. because again, things can change daily. But if you take that long-term perspective with your portfolio and take a 5, 10, 15-year approach to it, that should pay off when it comes to managing that volatility, especially that emotional piece. Some of the tax considerations, dividends versus interest. You want to pay off non-investment related loans, and you want to try and defer any capital gains that you have to pay. Generally, this isn't applicable if you have only an RSP or a tax-free savings account, but it is applicable if you invest outside of these plans in a non-registered fashion. So selecting an advisor, I'll just spend a minute on here so that I can take the questions. So you want to maybe ask for recommendations from family members or friends as to who they're dealing with. You want to maybe get a couple of names of different people and have some interviews and see where the right fit is. You want to talk about expectations with your advisor and make sure that you're both on the same page. And you also want to know what those costs are going to be. Is it going to be an annual fee that's charged to my account or commissions? Are you going to charge me a commission every time you buy or sell something? The services that are provided by your advisor, if you are dealing with an IROC advisor, so someone who works for BMO Nesbitt Burns, for example, or CIBC Wood Gundy, or TD Waterhouse, RBC Dominion Securities. So the services that are provided by your advisor are financial planning, wealth planning, that making sure you've got a plan in place. You also want to revisit that plan, I think, on an annual basis to make sure you're on track to reach your goals. That person is going to help you with setting those goals and those objectives. They should be providing you with investment research and advice, asset management, so the investment management piece, progress reports, so you should be getting monthly statements. And if you don't have any activity in your account monthly, then you would be getting them on a quarterly basis. You want to have make sure that you're in contact with your advisor to get financial updates and portfolio reviews. Obviously, right now, we are all dealing virtually, so there's not really any in-person portfolio reviews happening, but we are doing Microsoft Teams reviews, right? Like using Microsoft Teams to do reviews, or just over the phone. And those service expectations. So how often are you going to be getting in touch with me? And what does that look like? So I'm going to take some questions now. I'm going to stop sharing my screen. But again, thank you so much for listening today. My name is Keeley Simpson, and here's my contact information. We will also send that out to you in case you have any follow-up questions after. I'm going to look at these questions that were sent in so that we can get started on these before the presentation ends. So the first one is, what is cryptocurrency and is it a legitimate form of investing? So I am getting a lot of questions on cryptocurrency right now. It is a hot investment topic. To me, it seems more like a black box. I don't really understand it, to be honest with you. I mean, I understand it, but I don't know why you would risk the capital when you don't really know where it's actually going. So cryptocurrency to me just seems like it can be a bit more of a risky form of investment. Obviously, with risk comes more, it can come with greater reward, or it can also come with greater risk. So if you are able to, from a risk management perspective, if you are able to, stomach that risk, in other words, be comfortable with taking that risk, then, it could be a good investment option. The other thing is that cryptocurrency tends to be quite illiquid. So if you were going to invest in cryptocurrency, I would actually consider what's called an ETF, so an exchange traded fund that focuses on cryptocurrency. So that's something that I would look at, and that way it's something that you can buy or sell yourself and that you have access to without actually buying the cryptocurrency that you may not have access to the capital down the road. I actually had a client who was preparing to buy another house, but he ended up buying some Bitcoin, and he did well on it because of the timing, but then it all went down, so then he didn't do well. But the point is that he didn't have access to that capital because when he tried to sell, there wasn't a buyer. So also the bank isn't going to lend on that that asset because it's so volatile and we don't really know where it is. So it's kind of like this black box, right? So it's just really important that if you're going to buy it, then maybe you should look at buying it through an exchange traded fund versus actually buying the cryptocurrency itself. What would be the checklist for 30 years to retirement? I think it's all the same. You want to have a continuous savings plan. You want to have a budget. You want to make sure that you're paying yourself first. You want to make sure that you're minimizing your taxes and wherever you can. And it's really very similar. It's just that when you are getting closer to retirement, you want to make sure that you have an actual retirement plan in place. What is an ideal asset allocation, fixed income versus equities in your 30s or 40s? So I think this is a personal decision because you want, I mean, what's ideal is at this point, I mean, generally you would probably want to focus more on equities because you have a longer time horizon and interest rates are so low that your rate of return in that fixed income basket is going to be low for some time. And there's also risk in fixed income right now because interest rates are low and we're going to probably see them go higher. That means that the bond prices could go lower and you may have a negative rate of return on that part of your portfolio before you see it turn around. So I would actually be focused more on equities, especially if you're in your 30s or 40s, equities that pay you dividends, that you can rely on if the market goes down. You can, have that dividend reinvestment plan started so that you can continue buying units of those of that stock at a discounted price. What are your thoughts on all-in-one ETFs? I think that they are great. They give you access to the market and at a very low cost. So I think that this is actually a great option if you don't want to, buy specific stocks or bonds or stocks, for example, and you just want to have a broad market index. That's great. I think it's a great option. I find that investing safely without risk to base amount gives back very low returns, 1% or so. What would you recommend? Well, again, it goes back to the safety piece is really getting that guarantee. That guarantee comes at a cost. It comes at a cost of how much is your rate of return going to be. It's going to be very low, especially right now because rates are so low. I would recommend looking at dividends. Maybe a dividend paying exchange traded fund. There are ETFs out there that are focused solely on dividend paying companies. Like the ETF could be a broad market index, but specifically in that index, only the companies that pay dividends. That's maybe something to look at. Where is the best place to save your emergency fund? Unfortunately, it is in your savings account because it is exactly that. An emergency fund is something that you need to have access to in case of an emergency, which means that you don't necessarily want to have it invested, because if you have it invested, then that means you would need a few days to sell the investments to gain access to it. And then if that happened at the same time as a market downturn, then that amount may not be what you expect it to be. How does someone who makes between 50 and 90 ever manage to save $1 million for retirement? Portfolio is low, as well as savings toward RSP and TFSA tips. Okay, so yes, if you are making between 50 and 90,000 a year, how do you ever manage to save $1 million for retirement? Well, you get there with a continuous savings plan, and you just keep chipping away at it. There's no perfect solution in this scenario. You just need to find the money in your budget, and you have to be diligent, and you have to make sure that what you are investing in your plan is going to work for you. So if we remember that 2% difference that we talked about a little bit earlier, it makes a difference. Compounding makes a difference. So you wanna have that lens on when it comes to that. So I think that's all the time that we have today, because oh, there's a lot more questions. Okay, I will answer a few more questions. So if you need to go, I totally understand. Thank you all for coming. I'll answer a few more of these questions just to make sure that we answer some of these. So, okay. What are some of the strategies to deal with the threat of inflation? How can you best protect your investments, and what are the best things to invest in? So going back to that dividend reinvestment plan, that's really something that I think will build up over time. So if you take that, and then there's also tips. So it's Treasury inflation protected notes. If you really want to get technical, you can go and buy those, and they provide you, it's an ETF, and it provides you with exactly that. It's a strategy against the threat of inflation, which you could add into your fixed income element of your portfolio if that's something that you wanted to do. How do you get the 2% higher rate of return? Well, you need to work with someone or have someone that you trust, and you need to look at what you're investing in to constantly have your money working for you, and you want to be diligent with your plan, and that's how you get the 2% higher rate of return. How realistic is a 10% rate of return? Well, that depends on the market conditions. I think right now it's not unrealistic by any stretch. I think if you have the right strategy in place and you're focusing on the industries that are outperforming right now, I think a 10% rate of return is attainable, but it also can come with some risk, which means that if you have 100% of your money invested in equities, then you may have some risk to your portfolio with that if the market altogether went down. So I do think 10% could be realistic. I wouldn't use a 10% rate of return when it comes to planning. We always use 6% or even 5%, it depends. And that's sort of like the bonus amount. Do I think index funds are a good method of contributing to an RSP on a yearly basis? Yes, I do. Yes, your money is going to grow faster if you invest in an index fund than it would if you bought a GIC, because the index funds at least are participating in the growth of the markets. And then that's something that you can also put that dividend reinvestment plan on. And that way you can also be continuously buying more units of it throughout the year. Instead of contributing to an RSP, shouldn't I pay my mortgage faster? Well, it depends on your marginal tax rate, because if you have a high marginal tax rate, then you would be paying more into taxes for the year than if you contributed to an RSP. So when you contributed to that RSP, you would be getting a tax refund from the CRA, and then you could use that tax refund to pay off more of your mortgage so that you're maximizing where you can get all of your funds from. Okay. All right, great. So thank you all again for joining today. There is going to be a survey that's going to be sent out, and we're also going to send out some follow-up items for you if you are interested. So please fill out the Survey Monkey and let us know if you have any questions. And again, thank you very much for joining today, and stay safe.